Despite companies so far largely beating expectations for the fourth quarter, the softening S&P 500 earnings backdrop still spells trouble for stocks, according to a recent RBC Capital Markets report. Where may investors be looking to, and where may the market be headed? We're here to discuss is Neil Shah, Edison Group Director of Research. Good to see you, Neil. So, as we're seeing here, this is a better Q4 earnings season so far, as you said in your note, than you expected. But what do you attribute that to?
I think that the consumer has been more robust than a lot of people feared, particularly around the holiday season, and it varies by region. So you're seeing signs that actually Europe has fared a lot better than perhaps the US has. And last time I was on the show, I think there was a lot of nervousness about how Q4 ended. We've come into January, a lot of companies reporting actually positive trading updates, and I think that that's being reflected in a buoyant market that we're seeing today.
And Neil, you are saying that we're currently in a sweet spot between easing inflationary pressures and corporate earnings potentially deteriorating. So then how should investors approach this period?
It's tricky. I think this year is going to be a tricky year for investors. I was reading one investment house's note, and their assessment was that the portfolio you want for the next 6 to 9 months is very different to the portfolio you want for a decade of investing. And you've got to make up your mind how long-term you want to be in your positioning. Right now, what we're seeing is that all the sectors that kicked you in 2022, have been kissing you in 2023. Whether you want to be in those stocks long-term, I think is a big question mark. So we've seen a rotation out of, for example, consumer staples into consumer discretionary. There might be some good reasons for that. We can talk about some of the themes we're looking at. But I think that you need to be reasonably nimble as we are in this market. You can participate in the market, and I think you want to be rotating in and out of sectors.
And Neil, speaking of those key themes that you're going to be watching this year, baby boomers' wealth, geopolitical tensions, industrial automation, natural resources, and oil, which one do you think has, the most propensity to do the most damage to markets or to really shift the narrative this year?
I think look, there's my view is that the winners of the last decade will be are different to the winners of the next decade. And I think we're seeing a pivot in the market. We started to see that rotation out of long duration growth stocks as rates started going up into old school economy names, particularly companies with real assets, cash flowing businesses, people looking for dividend yields, and old school industrial names where the valuations were slightly more attractive. Now, looking forward, some of the things that I would look to play are that I think that you're going to find upside surprises in certain sectors. So let's touch on this idea of you've seen actually consumer discretionary, particularly in Europe, outpace consumer staples. One of the things that we're starting to see is that the baby boomer generation, who is coming up for retirement, and there's a massive pool of wealth, is not necessarily passing it on to the next generation. I think this COVID impact has meant that people are looking to treat themselves, spoil themselves a little bit, and you're starting to see them spend on some of the top performing sectors. So travel, leisure has done reasonably well. And that's a theme that I think you can start to, you may look to play. I think it's early days, so you want to see some points validating that. But luxury goods, for instance, is an area where I think there's quite a lot of interest. I also think that the geopolitical environment is one which is going to persist. We've got this situation in Russia. China's coming out of its lockdown, but I think that's going to remain an issue for the markets over the next 12 months. And one of the things I think policymakers are going to be focusing on more than ever is energy security. And one of the things we're looking to play is the switch of energy from east to west to actually north to south. So the energy fields in Africa and Northern Europe start to take much more of a sort of strategic importance. And we're starting to look for points of value in companies operating in these areas. So I think it's very much the nature of what I'm discussing is it's a stock pickers market. You need to find interesting long-term themes that are going to contribute to growth that outpaces inflation, that offsets a depressed demand environment. And it's worth participating in the market, but I don't think that you could just, buy a general ETF. I think you'll struggle if you do that. I think you need to find interesting plays in the market.
So it sounds like a more targeted approach, as you're mentioning there. And I want to talk about a trend that you mentioned, because you're talking about this orderly deflation of assets that we're going to see. We saw it last year with tech and some of these longer duration ones. But this year, you're expecting private equity and real estate to be more in focus. How do you see that unfolding?
I mean, it's the Warren Buffett thing of, when the tide goes out, you'll see who's swimming naked. It is, a lot of private equity firms, for instance, will have invested in things. Those where, they've invested using financial engineering are likely to be caught out because it's getting more costly to borrow. And I think that, the possibility of write-downs is there. Those who do the harder thing of actually improving the assets that they're investing in potentially stand a chance. So I think that the private equity sector is going to see some pressure in terms of the values that it's holding of its holdings, etc. Are you going to see write-downs? And a lot of the focus this year is going to be on that sector. And I think it's going to be a slightly more challenging environment. Real estate is in a similar kind of situation. Rates are going up. You're already starting to see weakness in the housing market, but I think you're going to start to see that more broadly in the commercial real estate sector. And again, I'd focus on, are you going to start to see the possibility of some write-downs in that sector? The main thing I'd focus on is that it's not panic. I think it's an orderly adjustment of valuations to a new environment. And I would, for the reasons I've set out, I'd be cautious about those two sectors because I think those are going to come into focus this year.
Everyone certainly has to do their homework in this environment. A big thank you there to Shah, Edison Group Director of Research. Thank you for your time this morning.